The stock market can seem like a very complicated place, and that is by design. With all the different markets, different instruments, things to trade, I think they intentionally make it complicated and confusing. If you watch films like The Big Short, they get into this as well, talking about how they use big words on Wall Street to confuse you and so that you don't pay attention to what's going on. I'm gonna go over some of the basics to jumpstart your journey, specifically regarding trading options. Now, the first thing we need to discuss is the difference between investing and trading. Investing typically involves a longer time frame. You're using time to build a position in a certain stock or asset and hoping that that will grow, and who knows, 5, 6, 10, 20, 30 years down the road, you're going to be selling that at a much, much higher price. And that is what investing is: accumulating a position over time with hopes of selling it long ways down the road. Something similar to what Warren Buffett does, which is just buying and holding stocks over a long period of time. One of my favorite quotes by Warren Buffett is that nobody wants to get rich slowly. And that is kind of true sometimes. Unlike investing, trading typically involves buying and selling instruments or stocks or options on a shorter time frame. You're looking to capitalize on volatility and market fluctuations to make bigger gains over a smaller period of time. Depending on that time frame, you can describe trading in a few different ways. Day trading means that you're going to buy and sell an instrument in the same market trading session, which in the case of the stock market would be from the opening hours to the closing bell. In the case of the New York Stock Exchange, the stock market does open at 9:30 a.m. Eastern Standard Time and closes at 4 p.m. Eastern Standard Time. So if you were to buy a position in the morning, sell it at night, or any time between that, whether you're holding it for 5 minutes, 10 minutes, an hour, 2 hours, if you're buying and selling it in the same market trading session, that would be considered day trading. If you hold a position for a longer period of time, say a couple of days, a week, a month, a year, you could call that swing trading. There are different ways to trade and trading strategies, and this is just meant to be an overview of the power of options and what options can do. Again, this is meant to be a quick introduction to options trading, what options are, what options can do, in hopes to simplify it so that you get a better understanding and a better foundation to start trading options if that's something that you're interested in. Now that we know the difference between investing and trading, let's get into some options basics. An option is a way to control a larger position with a smaller amount of capital, in the sense that one option is controlling 100 shares of the underlying. For example, if you were to buy a option in Tesla, you would be controlling 100 shares of Tesla for a smaller fee. There are two types of options: a call and a put. A call is a bullish position, meaning that you think the price of the underlying will go up. And a put is a bearish position, meaning you think the price of the underlying will go down. Specifically, the option gives you the right, but not the obligation, to buy or sell that stock at a certain price. If you buy a call, you're buying the right to buy 100 shares of a certain stock or a certain underlying at a certain price. If you're buying a put, you're buying the right, but not the obligation, to sell a certain stock or certain underlying at a set price. That price is called the strike price, and we'll get into strike prices and expirations here in a bit. But I want to go over a few things regarding that main statement. Purchasing an option grants you the right, but not the obligation, to buy or sell a set stock. One of the biggest mistakes that I made, that new traders make, that losing traders make, is gambling with options. We'll get into some mistakes that traders make here towards the end of this video, but I want to reiterate that because using options as a way to gamble is a way to lose money quickly. I've done it. I've lost money treating it as a gamble instead of treating it as a trade. And that is one of the biggest things that separates successful traders from unsuccessful traders, is risk management. Every single successful trader, long-term trader, preaches risk management. I think a lot of traders, when you see them take that jump from unsuccessful to successful and consistently successful in terms of consistently profitable, it's following proper risk management, and we'll get into that. A big disclaimer when it comes to trading options is that there is a bigger risk because you can lose everything if that option expires, versus if you're buying a stock At the end of the day, you always own that stock unless something happens to the company, which can be just as volatile as, say, trading penny stocks or trading crypto or trading stocks that get delisted. That might be a story for another video. Let's use Netflix as an example, ticker being NFLX, and look at some different trades you could make and how you can make more money with a call option versus just buying the underlying stock. Trading options comes with a significantly higher risk than trading stocks, but you have the potential for higher rewards. Let's take a look at this example using Netflix. So here we have two charts. Let's take a look at these. The chart on the left is the Netflix daily chart. The chart on the right is a chart for a call option of Netflix, specifically the 475 call that expires on December 29th, 2023. For reference, I am recording this video on December 19th, 2023. So this option expires 8 trading days from now or next Friday. I'll go over strikes and expirations in a bit, but let's just take a look at these charts first so we can see the potential of what an option can do and the higher percentage of gains you can make on a trade like this. If we look at the daily chart of Netflix, you can see that it has had some volatility over the past 5 or 6 weeks. Starting on November 10th, it went from a low of 435.51 up to a high of 496.14 today. Meanwhile, it hit a peak of about 480 here before pulling back to around $446. Let's say you did a nice trade and you bought a single share of Netflix on November 10th for $436. You held that share and sold it today near the highs for $495. You would have made $59 in 27 days, or about 13.5%. Now, 13.5% in 27 days is pretty great. That could be a nice trade, and if you had 100 shares, you could have made $590 in 27 days. But those 100 shares would have cost you $4,360. Now, let's take a look at the option chart for the 475 call that expires on December 29th, 2023. If we look at this chart on the same day, November 10th, we'll see that this call had a low of 680. Remember, options are equal to 100 shares. So to buy control of 100 shares on this particular strike and expiration, we would multiply it by 100 to get the price. In this case, 680 is equal to $680. Let's say you didn't get it right at the low, but you bought it for around $7. That would cost you $700. If we look at today's price, this call hit a high of $22.20, so $22.20. You multiply that by 100 to get the actual price, we would have $2,220. Let's say you sold it around 20. You would be selling it for $2,000. So with this Netflix call, you could have bought it for $700, then sold it 27 trading days later for $2,000. That would be a $1,300 profit, or about 185%. But let's take a closer look. Just like the chart of Netflix, if you look at the daily chart over here, it goes up and down and goes back up. The call option has the same kind of chart. It has its highs and its lows. Let's say you waited because it was too expensive for you or the risk wasn't there. The call comes up to the $20 area or $2,000. And as the cost of Netflix falls, the price of the call plummets as well, down to a low of about $2.50 here on December 6th, which again, multiplying it by 100 would give you a cost of $250. Let's say you waited and you were watching Netflix and you saw Netflix start pulling back and you bought it down around this area between, December 4th and December 6th. For this example, we're going to say you waited till December 6th and you bought it, right when it started coming back up. So let's say you bought it at the low for $2.50. Multiply that by 100 and you're now getting that call for $250. Well, if you held that call for 1, 2, 3, 4, 5, 6, 7, 8, 9 trading days, and say you sold it today near the highs at around $20, which wouldn't be bad because if you looked last time, it kind of rejected around that $20 area, and you sold it here for the $20, that would be $2,000 since you're multiplying it by 100 because a call gives you the right to 100 shares. So that $20 is equal to $2,000 on a call option. So let's say you did that, you bought it for $250, sold it for 20. In other words, you would have bought it for $250 and sold it for $2,000. We would have made a profit of $1,750 or 700%. So that is the power of trading options. But what risk do we really have here? If we're looking at the chart, say you bought a share of Netflix, you bought it for $436 and you held that for however long, the next 10 years or so. Netflix continues going up and down. At the end of the day, the only way you're really going to lose that money is if Netflix goes bankrupt, Netflix gets delisted, whatever happens, the share price gets diluted and Netflix just falls and collapses. When you buy a share, at the end of the day, you're always going to have that share until something crazy happens. In the sense of an option, because they do have expiration dates, if you buy a call, and in this case, this is a December 29th, 2023 call. If you waited till December 29th, 2023, and this call had no value, you would lose everything. You wouldn't hold on to a share still the next day on that Saturday or the next market open on Monday. You wouldn't have a call to hold on to. That call would just be worthless and you would lose everything. But let's really break this down. If you spent $436 to hold one share and you're cool with that, and you're holding that over time, who knows what can happen? Maybe it 10x's in 10 more years and you make $4,000 in 10 years. Great. But if you were to kind of trade this chart and follow proper risk management, risk reward, you could be risking $250 to make $2,000. So really, it does kind of limit your risk in a sense, because when you're buying an option, you can only lose what you put into the option versus, say, you're short selling. So again, the potential here was 700%. If you would have bought it around the lows, you wouldn't even have to make a perfect trade. You could have bought it on the way up, maybe bought it around $3, $300. But that whole potential of there's a 700% move here, actually higher if you look at the actual top of the day where it closed at. It's about 800%. The potential there is so much higher, and you could have bought this around the low, sold it up here when it came down, bought it again, and that's what trading is. Trading is capitalizing on movements. Obviously, looking back, hindsight's 2020. When you look at this chart in retrospect, it does seem a lot easier. Like, oh yeah, you could have just bought it here, sold it, bought it here, sold it. It is very hard to time the market that way, but if you're following proper risk management, which I'll get into, you could be doing things in stop losses to protect your money. And that's one of the biggest things you need to do as a trader, especially is protecting your capital. But a lot of people struggle with that. And we'll go into that with some of the mistakes that traders make and some mistakes that investors make. But in the sense of options, the potential for higher rewards is there. And that's why if you just look at this as a trading instrument and not as an investment, you could have even bought it back here for $600, $700, made $1,300, and then waited, saw Netflix keep falling down, bought back into it. When Netflix fell back down here, bought back into the option for even lower, or even bought more. Maybe this time you buy 3 options because you spent $700 here, you made $1,300. Now down here, you can buy 3 options for $300, for $900. You could buy 3 options for $900 using the gains you made from this sale, and then you could have sold them back up here for $6,000. Now look at that. Now you're making $5,100 on a trade. Again, hindsight's 2020. It's easier to look at this and analyze, but as they say, look at the past to predict the future. Patterns repeat. This is a way to analyze a trade and see how we can do this in the future. If you were doing this today, we'd be trying to find a good spot. And this is a way, if you're looking at a stock and you're like, you know what, it's dipped, let's dip buy this. You can do that with an option and really capitalize and make a lot more money. There are a lot of factors that determine what a option will cost, but the 2 biggest factors we need to look at are the strike price and the expiration date. Again, this video is about options basics. There are a lot more things that go into pricing an option. Those things are called Greeks. We can get into Greeks in another video. If you want to let me know in the comments that you want a video explaining the Greeks, we can get into that. But for the sake of this video, we're just going to be discussing options basics. And the most basic way you can trade options is by looking at the strike price and the expiration date. You can think of the strike price as a target. The strike price is essentially the price that you think the underlying will reach. For example, if you go back to Netflix, if you buy a $500 call, you're betting on the price of Netflix to go up to $500. Conversely, if you buy a $300 put, you're betting on the price of Netflix to fall to $300. The next factor that comes into play is the expiration date. The expiration date is the amount of time you think it will take for your trade to go in that direction. And again, if you're bullish, when you think the price is going to go up, you're going to be buying a call option. If you're bearish, thinking the price is going to come down, you're going to be buying a put option. Once again, purchasing that option gives you the right, but not the obligation to buy or sell that stock at that price. Now, the expiration dates typically land on Fridays in the sense of some instruments like SPY, which is the S&P 500. Those do have contracts that expire every day, and you can trade a thing called zero DTEs, zero dates. We can get into that again in another video, but for the sake of this video, especially as a beginner, you should avoid zero DTEs as much as possible. A lot of people will jump straight to zero DTEs because they see the higher percentage gains capable, because if there's a lot of movement and volatility in the underlying, that price of that option can go up or down very, very quickly. You saw when we were analyzing the Netflix trade, the discrepancy. You can get a 700% gain in the span of 10 days. You can get that in the span of a day with zero DTEs. But again, that carries a much higher risk, because if it goes against you, you can lose value very, very quickly. When looking at the value of a contract, you got to take into consideration two things: the intrinsic value of that contract, as well as the time premium. The intrinsic value of a call option is the share price minus the strike price. If the strike price is higher than the share price, the intrinsic value would be zero. With a put option, the intrinsic value is determined by the strike price minus the share price. If the share price is higher than the strike price, you're going to have a negative number, meaning that the intrinsic value of that contract is zero. The next thing we need to consider is the expiration date. The expiration date is how long we think it will take that contract to get to that set target. The time premium is the remaining value of the option after you subtract the intrinsic value of that option. The time premium is determined by how much time is left until that option hits its expiration date. The closer an option is to an expiration date, the faster it will lose value, but also the faster it can gain value if it's going in your favor. We can refer to contracts in two different situations: ITM meaning in the money, or OTM meaning out of the money, in the sense that if a contract is in the money, that means it has intrinsic value because it is at the price that you were looking to target. In the sense of a call, if you had a $400 call on Netflix and Netflix is above $400, you have that intrinsic value and your contract is in the money. If you bought a put for $300 and Netflix falls below $300, same thing. You now have intrinsic value because your put option is below your strike price, giving you an in the money contract. With out of the money contracts, you have a higher reward with a lower risk because all you're losing is that time premium. So we're going to take a look at some different option contracts by looking at Coinbase, ticker COIN. Coin. I'm going to be taking a look at the options chain using Thinkorswim by Charles Schwab. Now, I like using Thinkorswim. It is my platform of choice. It is now run by Charles Schwab. Charles Schwab bought it from TD Ameritrade about a month or so ago. I'm glad that they continue support for Thinkorswim because it is a very, very good platform. There is a lot of access in this platform for free. There's a lot of interfaces. You can really customize the UI to suit you. And it can be a little complex to start off with. Now, you might have some more user-friendly things like Robinhood or Webull that are more visually appealing. But Thinkorswim really, really has a lot of tools. And once you really customize it and get yourself familiar with it, it is really, really great. Let's take a look at the option chain here for Coin. Here's our option chain for Coin. We're looking at our expirations here. And now they're broken up by weeklies, quarterlies, monthlies. You can buy contracts out as far as January 16th, 2026. This is the way they're broken down. It's the day of the month the month, and then the year. So again, 22 December 23rd would mean December 22nd, 2023. 5 Jan 24 would be January 5th, 2024. And then here you could see the expiration dates. So this is 3 days to expiry, 10 days to expiry, 17 days to expiry, all the way down to 759 days for expiry. You'll see that the further away the contract is, the more expensive it is. That is because there is more time premium tied to that contract. Let's take a look here. We'll break down 2 windows. This is a weekly, and then we'll look at January 17th, 2025. So now we can look at our strikes. Here is the strikes. This is expiration, December 22nd, 2023. These are our strikes. Same thing down here. Expiration, January 17th, 2025. These are our strikes. Let's look at the same strike. We're looking at 160. So Coinbase closed today at 160.116. We are looking at 160. This is going to cost us currently trading at 485. So that we're multiplying that by 100, be $485. So for $485, you can buy control of 100 shares targeting 160 strike price. These would be in the money, and you'll see that these are purple over here. These are our calls on the left. These are our puts on the right. Puts, calls. So calls on the left, puts on the right, with our strikes here, expiration here. And you can really do a lot here. We can show more strikes if we wanted to, but in this sense, I think, 14 is good. If you go down to all, you can really, really break down these option chains. We don't need to look at all that. We want to look at the 14 closest. So that's going to be 7 in the money and 7 out of the money on both sides. So we're looking at this. If we're looking at the 160 strike for this week's expiry, you're looking at $485 for one call. Now, go down to our January 17, 2025, 160 strikes. You're looking at 52 here. So again, multiply that by 100. You're looking at $5,215 for that same strike. That is a lot of money to control 100 shares for that far out. You don't really need to do all that. You can if you're really, really bullish on the stock long term. That is a way to do it. If you're going to be doing long-term trading, buying leaps is a good path for that. And you could do this if you really, really were bullish on this stock and you thought that Coinbase is going to keep going up over the next year and a half, about 13 months. But I wouldn't recommend that. Again, to each their own. Everyone has their own strategy. We're just looking at this as a way to break down the option chain. So that's what we're looking at, strikes and expirations. You'll notice on the call side, if you go down, the price decreases, and that's because this is further out of the money. So the only value we have here is the time premium. If you go in the money on our calls, you're going to have the intrinsic value plus the time premium, which is increasing the value of that contract. Same thing on the put side. Everything that's out of the money, this means because the price is above 160, right? So everything below 160 on the put side is out of the money. These only have time premium attached to them. As you get in the money, now 170 is above the current price of coin. So this is going to have intrinsic value plus your time premium, and that's going to make these more valuable. As these get closer to expiration, you're going to lose the time premium, but if you're getting in the money, you're going to get some intrinsic value. So the things you want to look for is IV, your delta. There's a lot of different things, your volume, your open interest. There's a lot of things that we can get into in further videos, but again, for the sake of this video, we're just looking at strikes and expirations. Here's an option chart for coin. This is the daily on the left. Now, on the right is a chart of the option contract, specifically the December 29th, 2023 $100 calls. As you can see here, this has been going up, and this is because if you look at the coin chart on the left, coin has been going up since back on October 30th. If we look at the daily and you look at coin on November 13th, coin had a low of 88.62 and a high of 93.27. Let's say you bought 6 shares of coin at $90 a share. You got filled at $90 a share. Now, 90 times 6 is equal to $540. Similarly, if you looked at the option contract, $100 calls would be out of the money, right? If you're looking at this chart on just the 11/13, you're just right here. You don't know what's going to happen. $100 is out of the way. You can see that it hit $100 and came back down. So right here, you get some bullish action. You know, it's getting a lot of bids. It kind of went down, then bounced back up, and then closed higher. Instead of buying 6 shares for $90 each, we're going to buy one contract, one call option for $100 strikes for December 29th, 2023 for $540. Again, the low here was $540. Multiply that by 100. That's $540. If you had bought 6 shares, that value would have gone up, and you could have sold it today for, at the high, 162.09. So say you sold it at 160. So you could have sold your 6 shares for $160 each and made a total of $420 profit. Not bad, you know, making a total of $420 profit. That's almost 100%. You're about 77% gains. So you would have made about 77% on that trade, a little bit more than 77%. So that wouldn't have been too bad. That's a nice trade there. But if you would have bought an option for $540 and sold that today, you hit a high of 60. Multiply that by 100, you're looking at $6,000. Subtract your initial buy-in of $540, you would have made a profit of $5,460 in the course of about 5 weeks. Again, November 13th to today's December 19th. That is significantly higher. This would have been a 10x trade, 1,000% gain in the same time frame that if you would have bought the stock, you would have made a 77% gain. This is all hypothetical. I didn't take this trade. I'm just using this as an example. Another good thing about doing this is it lets you break down and analyze trades and look for patterns in the future. You can see, would it have been smart to buy coin at that price? Would it have been smart to buy a call at that price? So that's another look at how the power of options can make you a lot more money instead of just buying stock and having a lower reward on the same time frame. Now, if you're looking at this chart, if you would have bought it here, there really wasn't much downside. You had so much time, and this hasn't ever really came back. This is a pretty safe trade. Again, hindsight is 2020. Myself analyzing this trade, I'm kicking myself, asking myself why I didn't take this trade. So here's an example of a chart that's trending down, and we're looking at Pfizer. So Pfizer here, back in July was trading around $36, $37. It's lost a lot of value right now, and it's down to about 28. It did have a little bit of a bounce the last couple days, but we can see that on the put chart. So on the left here, you have the daily chart for Pfizer. Let's zoom in a little bit and get a little bit of a closer time frame. On the right, we have a put option. So the put option here is for December 29th, 2023. Again, that's 8 days away. That's next Friday, for a $30 strike. There's different ways you can capitalize on the downward movement of a stock. You can sell calls, or you can buy puts, or you can short the stock directly. Shorting the stock is inherently risky because when you short a stock, there is no limit to the amount of money you can lose, because when you short a stock, if that stock shoots up, you lose an infinite amount of money until you cover your sale. When you buy a stock, you can only lose the value of that stock. So if you buy a stock for $30, if that stock goes down to zero, you can only lose $30. If you short sell a stock and you say you sell that stock at $30 and the price shoots up, you can lose an infinite amount of money. If it goes up to 50, you're down $20. If it goes to 100, you're down 70. If it goes up 200, you're down 170. So on and so on. I hope you get the picture. But if you buy a put, you can only lose the value of that contract. Similar to how a call, you can only lose the value of the contract. So in this case, let's look at Pfizer. So let's take a look at Pfizer. If you look at around here on the 26th, we seem to have hit a little bit of a high, came back down, it bounced up. Let's say you bought puts in this area because Pfizer's been trending down. You saw that bounce, you're buying puts here. If you would have bought a put for Pfizer on November 27th, let's see, that value down here on this put contract for $30 puts would have been, you could have got it anywhere from 60 cents to 80 cents. Now, multiply that by 100. You're looking at $60 to $80 for this contract. So let's say you short sold this stock here around $30.50. So for $30.50, you short sold Pfizer, and then you covered over the last couple of days, you covered here at 26.50, you would have made a total of $4.25 per share. Now, you could have also just bought a put contract, a $30 put contract. You could have bought it here for anywhere from $60 to $80, held it, and you could have sold it down here, somewhere in here where it bounced down, but it hit a high of $425, which is $425. Let's say you didn't reach the bottom and you sold it the next day for whatever reason. You sold it here for $3.50. Again, we multiply that by 100. That's $350. So with your initial investment of buying a put for, let's say you're in the middle for $70, you could have bought this down here for $70 on the 27th. You could have bought a $30 put on Pfizer for $70. You could have sold it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 trading days later. So about 2.5 weeks later, you could have sold it for $350 and you would have made $280. So $280 instead of $4.25. So that is the power of puts. You're capitalizing on the downward movement of a stock versus the upward movement of a stock that you would be capitalizing when you buy a call. Both viable ways to trade a stock. The biggest thing we need to take away from this is, again, you're trying to capitalize on that movement, because if you would have held this, if you would have been up, you could have been up 500% here and gotten greedy. And because Pfizer is now bouncing and you're getting closer to that expiration date, we are now losing value faster. And you can see that that's back down to $2.60, which again is $206. You're still up. You're still up from what it was down here, but you've lost a lot of that value. You've lost almost 50% from the peaks. You're still up 300%, but you're down 50% from the highs. And that difference is $200. And looking at this chart, if you wouldn't have sold up here, if you would have kept holding, as we're approaching the expiration date, we're only 8 days away, we're losing value faster. So as this stock price is bouncing up, as Pfizer's bouncing back up, we're losing value on the put at a faster rate. That's the power of buying puts. You're capitalizing on the downward movement of the stock versus capitalizing on the upward movement when you're buying calls.